Let's examine pre-money value. It is what investors think your business is worth before their investment. It drives the price per share paid and hence the number of shares issued for the investment. Detailed founder valuation is what you hope your business is worth to an investor. And post-money value is pre-money value plus investment. Now, sometimes you'll see, like on Shark Tank, you will see founders saying they want $100,000 for 20% of their company. They really mean post-money 20% ownership, not before. They're going to sell enough shares so that when their shares plus the investors' shares are added together, the investors have 20%. The investors have roughly valued the company at $500,000. And you can do the quick seat of the pants math by taking 100% divided by 20% or whatever that number is, and the number of times it runs into that, and then multiply that times what that part is worth. So it runs into it 5 times 100,000 is $500,000. But the calculations get tricky from now on because it is post-money ownership. Let's just use Shark Cap Table fast to learn what is the pre-money value of the deal. Well, here we are. We don't need a lot of numbers because we're just going to use this number here, which is the percentage that the shark must own, the investor. And we're going to dial in the $100,000, and the proposed $500,000 is the pre-money value or valuation that the owners say they have. But the problem is the sharks aren't going to get 20% until this is lowered, and you keep on lowering it until you see it at 20%. But the pre-money value that actually sold the sharks their shares was $400,000, not $500,000. We're going to allow you to download for free from our website, www.sharkcaptable.com, Section A, which is the detailed founder valuation discussion, and B, talking points to support your detailed founder valuation, and C, the Shark Cap Table detailed founder valuation method. So here we are at Section C, Shark Cap Table detailed founder valuation method. So you can put your company name in here, but the key issue is what kind of cash has been invested. Well, maybe you got $30,000 in the deal. Have you any beta test revenues? Well, maybe you've got $25,000. But actually, if you had $25,000, I would suggest multiplying it by 3 or 4 times. So let's give it a $100,000 valuation, because those early test revenues are valuable in determining what your customer likes or dislikes. Intellectual property, well, you might have some trade secrets, you might have some patents, you might have a URL/website. There we go, processes. So maybe the trade secret's worth $50,000, and maybe your patents are worth $250,000. Might have to get some real people to look at your patents and do a freedom to operate. URL website, maybe you got $25,000 involved in that. And processes, well, maybe you got some secret sauce, we'll give that another $150,000. All right, how about your managers? If they were earning $100,000 last year and they were successful executives in a startup, I wouldn't put their $100,000, I'd put $300,000. Because after all, it's not their salary, it's what they do with their time. And maybe the vice president's worth $250,000. And maybe the financial officer's worth $150,000. Now, over here you got a section on market size and ability to capture share. Well, again, the reason we give you all these components is so that you can at least try to build an argument piece by piece. You could say, look, we've got a terrific market. It's huge. We're the first to be in it because we're going to change that market. So let's give ourselves $500,000 because we got $1 billion market. Other intangibles, well, you could just crank these in or you could leave them blank. So here we have a valuation in a couple of seconds based upon a number of factors for $1.805 million. All right, great. Let's talk about the talking points to support your detailed founder valuation. This is part of the salesmanship. So let's look at this. What is the problem being solved by your product or service, and why is it important? Well, you know, if you're going to make an also-ran thing that's just slightly better and slightly cheaper, forget about it. Explain why your product or service is awesome and why it is better than what currently exists. Well, number one and number two kind of go together. What is it that you're doing? Why is it so cool? Why does it have some terrific advantages? And if it's so great, why will users pay for it and how much? What does it cost you to acquire a customer? And what is the churn rate? Very important. If you have high churn rate and high expense in getting a customer, you have a big problem because there's no continuing revenue coming from existing customers. What is the size of the opportunity and share of market you intend to capture? Well, of course, everybody wants 100% of the market, and the market's $1 billion size. Think again. Discuss the strengths of your team and why you have the right one to do it. Well, that's all about the people that we just put some numbers in below. See if you can improve that team. What is the level of competition? Never, never, never say there isn't any competition, because that just isn't true. There's always competition. What are your competitive advantages? Features, price, distribution, management, connections. What is your current plan of attack? Best demonstrated in a timeline with phases. Oh yeah, I'm going to conquer the world and go to the moon. What is the project's current status? Where are you in your timeline? Well, how will you use your funding? What will be your development and revenue milestones? Like, plug them in, see where you are, see if you have enough money to make it. Now, Shark Cap Table has a summary of opportunity, and you will use these 12 questions to help you write that.